All right, let's get right into it. Welcome to today's explainer, where we're unpacking the incredibly fascinating and sometimes totally wild world of small cap investing. And we're doing it through the lens of an absolute market giant, the Nippon India Smallcap Fund. Whether you're actively hunting for explosive growth or just trying to figure out how these high-risk assets might fit into a modern portfolio, we're going to break down the data, the strategy, and honestly, the psychology behind this specific fund.
Here's our structural roadmap for today. We'll start off by defining small caps, then look at historical performance, dive into volatility and distribution, decode some risk metrics, compare it to peers and benchmarks, and wrap up by assessing long-term growth.
So, Part 1, defining small caps and looking at the SEBI rules. To start off, what exactly is a small cap fund? Well, according to the rulebook from SEBI, the market regulator in India, at least 65% of the fund's assets absolutely must be parked in companies ranked 251st and beyond by market capitalization. So the crucial takeaway here is that you're investing in early-stage, high-growth potential businesses. You're basically buying into the companies that could be tomorrow's market giants. But because they're smaller, they inherently carry a lot more volatility and business risk than your classic, established, blue-chip companies. Moving right along to Part 2, historical performance, or as we like to call it, boom and wealth creation.
Listen to this number, because it's the reason this fund is so famous. Since its inception, the Nippon India Smallcap Fund has delivered a staggering 24.7% compound annual growth rate. I mean, that is just massive long-term wealth creation. To put that into perspective, finding a business that grows from a 500 core market cap to 10,000 cores. That creates 20 times the wealth for early investors. And historically, the managers of this fund have been incredibly skilled at finding those specific companies way before the broader market prices in all that potential. When you map out that compounding effect over a 10-plus year horizon, it's mind-blowing. A 1 lakh rupee investment made at inception just compounds tremendously. It's solid proof that time in the market, especially when we're talking about high-growth assets, is literally the ultimate multiplier of wealth.
Which brings us to Part 3, volatility and distribution. It's time for a reality check.
Here's the thing about success, it brings scale. In managing a massive asset under management, we're talking exceeding 66,000 crore rupees here, fundamentally changes how a fund behaves. It introduces some very real liquidity constraints. You literally can't just jump in and out of tiny stocks quickly with that much cash. So to manage this, they have to hold over 180 different stocks just to diversify away the risk of a single business failing. And make no mistake, this category carries a high 50% drawdown risk during market crises. You have to be mentally prepared to see your portfolio value potentially drop by half during a severe panic.
So, how do they manage that immense scale in risk? Tactical allocation. They don't only hold small caps, they keep around 12% in large caps and 17% in mid caps. This acts like a vital risk cushion for conservative investors. It provides some much-needed stability and liquidity when those smaller stocks start facing extreme turbulence.
All right, Part 4, decoding risk metrics. Let's look at the math behind the volatility. We've got a few key metrics here that are absolutely essential for beginners assessing long-term capital growth. First, standard deviation sits at 19.38%, which basically measures the overall bounciness of the ride. But check out the beta of 0.86. Now, a beta of exactly 1 means an investment moves in perfect lockstep with the market, so a beta of 0.86 means this fund is actually slightly less volatile or less sensitive to market shocks than the pure small-cap benchmark index. To break it down simply, a positive alpha, which this fund has at 0.32%, shows the fund managers are successfully picking winning stocks and adding actual value beyond just riding the market wave. And that lower beta? That indicates they handle those scary market shocks better than average. So they're giving you the small cap engine, but they've installed slightly better shock absorbers.
Moving into Part 5, peers, benchmarks, and advantages. Let's see how it actually stacks up against the competition. When you contrast it against major peer funds, Nippon consistently outpaces the pack. Just look at a 5-year time frame. The fund delivered an annualized return of 36%. Compared to the category average of 32.09%. That gap right there, that represents significant extra wealth created for investors who pick this specific fund over an average competitor. And the story is exactly the same against its official benchmark, the Nifty Smallcap 250 Total Return Index. The benchmark returned 31.05% over that same 5-year period. This historical outperformance is the ultimate proof of value for active management. It shows the managers aren't just blindly buying the index. Their stock selection process is actually working.
But honestly, the true advantage isn't just hitting the peaks during bull markets. It's in the robust downside capture ratio of 79. What does that actually mean? Well, historically, when the benchmark index loses 100 points, this fund only loses 79 points. It bleeds last when the market panics. Add in their proven recovery through brutal cycles, like the 2008 and 2020 crashes, and you're looking at a heavily battle-tested fund.
Finally, Part 6, Assessing Long-Term Growth. This is the beginner's roadmap.
If you're going to jump in, you absolutely must follow these 3 steps. First, commit to a full market cycle. That means a 7 to 10-year investment horizon. Honestly, anything less is just gambling on market sentiment. Second, mentally prepare yourself for deep drawdowns. And third, utilize systematic investment plans, or SIPs. Because small-cap valuations can run really hot, investing a fixed amount every month averages out your entry price over time. It turns that scary market volatility directly to your advantage.
And keep in mind what you're actually buying here. Your SIPs are buying into a highly diversified engine of the entire Indian economy. The fund is spreading your money across industrial products, electrical equipment, banks, and healthcare. You aren't just placing a bet on one risky startup. You're taking a diversified stake in the broader entrepreneurial growth of the country.
So, I'm going to leave you with this final thought to wrap up our explainer today. When you weigh the high drawdown risks of up to 50% against the incredible, proven compounding potential of a top-tier fund, does this roller coaster belong in your financial plan? It's definitely not for the faint of heart, but for the patient investor, the historical rewards have been nothing short of extraordinary. Thanks so much for learning with us today.